Welcome to the deep dive.
Yeah.
Today we're going on a little journey through all the recent shakeups in the Dow Jones Industrial Average.
Yeah, it's been pretty wild.
Right. Think of it like we're kind of peeking behind the curtain, to see how this, iconic index is transforming.
Yeah.
And what that means for, your investments.
Yeah, what's really interesting is how these changes reflect a much broader market trend. We're seeing this pretty dramatic shift away from the old guard. Those solid dividend-paying companies and a surge of interest in companies focused on growth, particularly in tech.
So it's kind of like the Dow is getting a tech makeover.
Exactly. Over the past 5 years, the Dow has seen more changes than a chameleon in a rainbow room.
Oh, wow.
Remember when NVIDIA replaced Intel? That was a big signal about the future of computing.
Yeah.
And then Sherwin-Williams stepped in for Dow, which some see as a sign of shifting industrial landscapes.
Right. And now there's all this buzz about whether giants like Alphabet or Meta platforms could be next in line. Can you imagine the shockwaves if one of them replaced a household name like Disney?
It's definitely a possibility, and to understand why, we need to kind of dig into how the Dow Jones actually works.
Okay.
You see, it's a price-weighted index, which means that a company's stock price has a big impact on its weighting within the index.
Okay.
Sometimes even more than its overall market value.
Okay, so if I'm understanding this correctly, a company with a higher stock price could actually have more sway in the Dow, even if it's smaller in terms of overall market value, than a company with a lower stock price.
You got it. Think of it like a seesaw.
Yeah.
The heavier kid, representing the higher price stock, has a bigger impact on which way the seesaw tips.
Okay.
That's price weighting in a nutshell.
So this price weighting thing is kind of a big deal when it comes to understanding why some companies get the boot from the Dow, right?
Absolutely. Many of the recent companies that got removed, like Intel, Walgreens, ExxonMobil, and even Pfizer, had something in common.
Wait.
Their stock prices weren't keeping up with the Dow's average, and they were generally underperforming.
It sounds like if a company's stock price isn't cutting it, they risk getting kicked off the island, so to speak.
You could say that. And this is actually a reflection of what's happening in the broader market. Investors are increasingly chasing growth stocks, and those companies struggling to maintain their stock prices might find themselves replaced by more dynamic players.
Okay, so let's talk about Disney. Their stock hasn't exactly been setting the world on fire lately. Does this make them a prime candidate for removal?
Well, while Disney's stock performance has been a bit lackluster, it's too early to count them out just yet. They've actually shown some promising signs of a turnaround recently, particularly with their streaming service finally becoming profitable and their theme parks doing really well.
So the Mouse House might not be throwing in the towel just yet.
Not at all. Disney still has a diverse portfolio with a lot of value and appeal.
Right.
But this back and forth between potential removal and signs of recovery is really a fascinating case study, wouldn't you say? It shows just how dynamic the Dow can be.
Absolutely. It makes you wonder what the future holds for Disney and their place in the Dow. But let's shift gears for a moment and talk about those tech titans who are conspicuously absent from the index, Alphabet and Meta platforms. These companies are absolutely dominating the tech world, so why haven't they been included in the Dow already?
That's a great question, and it's something a lot of people have been wondering about. Their absence from the Dow is a pretty glaring omission, especially when you consider their massive market caps and the incredible growth of the communications sector. Remember, the Dow aims to be a snapshot of the American economy.
Yeah.
And without these key players, the picture feels incomplete.
So what's the holdup? Why haven't they been added yet? Is it just a matter of time?
Well, remember that price weighting thing we talked about?
Right.
Alphabet's stock price was sky high, which made it a bit of an awkward fit for the Dow. But their recent stock split has brought their price more in line with the Dow's average, making them a much more viable candidate.
So by splitting their stock, Alphabet has essentially made themselves a more attractive option for the Dow.
Precisely. And it raises an interesting question. Could Meta platforms follow suit with a stock split of their own? If they did, it could significantly increase their chances of joining the club.
Now that's a game changer. It makes you wonder which companies might be on the chopping block to make room for these tech giants.
Exactly. And there are some strong contenders for a removal. Think about companies like Verizon and Cisco. Their stock prices are relatively low, and they've been underperforming compared to the booming tech sector. They could easily find themselves on the chopping block if the Dow continues its shift toward growth.
So we could see a sort of double swap scenario, Alphabet or Meta replacing Verizon or Cisco,
Yeah.
Now, that would really shake things up.
It's definitely a plausible scenario, and it underscores this larger trend we're seeing. The Dow is becoming more and more reflective of a stock market obsessed with growth potential, sometimes at the expense of those steady dividend-paying companies.
This is all so fascinating. It's like watching the Dow evolve in real time.
Yeah.
But what does this shift toward growth really mean for the average investor like you? That's what we'll explore in the next part of our deep dive.
So before we kind of jump into what this means for everyday investors, let's step back and look at the bigger picture.
Okay.
This move away from dividends in favor of future growth. It isn't just happening in the Dow. We're seeing a similar trend in the S&P 500.
Oh, you mean how the S&P 500's average dividend yield has been steadily declining?
Yeah.
I've heard of some investors who rely on those dividends for income. They're starting to feel the pinch.
That's right. And it makes you wonder, what's an income-focused investor to do in this changing market? Are those reliable dividend payments becoming a thing of the past?
It sounds like they might need to adjust their strategy a bit, right?
Exactly. It doesn't mean they have to abandon dividends altogether, but it's important to diversify.
Okay.
Instead of relying solely on the Dow or the S&P 500 for dividends, they might want to explore other sectors known for their higher yields, like energy or utilities. They could even consider branching out into different asset classes, like bonds or high-yield savings accounts.
So it's all about adapting to the changing landscape and finding investments that align with your specific financial goals. Don't put all your eggs in one basket, especially when that basket's yield is shrinking.
Precisely. And this is why we love diving into these topics. It's not just about understanding what's happening in the market. It's about connecting those changes to your own investment decisions.
That's a great point. So let's bring it back to the Dow. This emphasis on growth over yield raises some interesting questions about what the index might look like down the road, wouldn't you say?
Absolutely. And we're not just talking about Alphabet and Meta potentially joining the ranks. This shift toward technology could have a ripple effect on other industries as well.
You mean like some sectors might end up losing their spot in the Dow as tech continues to dominate? Kind of like a game of musical chairs, but with multi-billion-dollar companies.
It's definitely a possibility. The Dow needs to reflect the changing landscape of the American economy. If certain sectors become less prominent, their representation in the Dow might shrink accordingly.
Okay, I'm starting to get the bigger picture here. It's not just about a few companies swapping places in the Dow. It's about a fundamental shift in how we value companies and how that shift is reshaping the entire investing landscape.
You've hit the nail on the head. And for you, the listener, this understanding is crucial. It allows you to anticipate potential changes, adjust your investment strategies, and ultimately stay ahead of the curve in this dynamic market.
All right, deep divers. We've covered a lot of ground today, exploring the ins and outs of the Dow's transformation. But before we wrap up, I want to bring it back to you. What stands out to you as the most important takeaway from our deep dive so far?
That's a great question. What really resonates with me is the idea that the Dow, despite being comprised of just 30 companies, acts as a powerful barometer for overall market sentiment.
It's like a sneak peek into the collective mind of Wall Street. You can see where investors are placing their bets and what they think the future holds.
And what's even more fascinating is that this shift towards growth in the Dow mirrors what we're seeing across the broader market. It's a reminder that the investing landscape is constantly evolving, and we need to adapt our strategies accordingly.
So for our listeners out there, the key takeaway is this. Don't just passively observe these changes. Dig deeper. Question your assumptions and use this knowledge to make informed decisions that align with your own investment goals and risk tolerance. What sectors are you most interested in? Where do you see the biggest opportunities?
Those are great questions to consider. We've given you a lot to think about, but remember, knowledge is power. And in the ever-evolving world of finance, arming yourself with insights like these can make all the difference.
We'll be back after a short break to wrap up our deep dive into the Dow Jones shakeup. Stay tuned. Welcome back to the deep dive. So we've been talking about this, this fascinating transformation of the Dow Jones.
Right.
And as we're wrapping up our deep dive, I'm wondering, what other insights can we glean from these changes? I feel like we've only just kind of, scratched the surface.
Yeah, no, I think you're right. These shifts in the Dow are really just like a small glimpse into the larger, forces at play in the market. But for those who are paying attention, these changes can offer really valuable clues about where the market might be heading.
We've talked about how the Dow is becoming more tech-heavy,
yeah,
and we've explored the implications for investors, who are prioritizing those dividends. But what about those stock splits? It seems like they're playing a key role in determining which companies are even, eligible for the Dow.
Absolutely. A stock split can be a game changer when it comes to Dow eligibility. Remember how we were talking about Alphabet's stock split, how that made them a more viable candidate?
Right.
I mean, it wouldn't be surprising to see other companies like Meta follow suit.
It's like companies are making these strategic moves just to position themselves for inclusion in the Dow.
Exactly. And that speaks to the significance of the Dow Jones Industrial Average.
Yeah.
Even though it only includes 30 companies, it's still seen as this, bellwether for the overall market.
It's like a window into the collective wisdom or maybe even anxieties of Wall Street.
Yeah. That's a great way to put it. What's really fascinating is that the Dow's shift towards growth isn't happening all by itself.
Yeah.
We're seeing this similar trend across the broader market. Investors are increasingly favoring, those companies that promise future growth.
Right.
Over those that offer steady dividends.
So the takeaway for our listeners is this. Don't just sit back and watch these changes, unfold. Get curious, ask questions, and use this knowledge to make, informed investment decisions. What trends are you noticing in your own portfolio? How might these shifts in the Dow impact your investment strategy?
Those are the questions every investor should be asking themselves. And remember, we've only just, scratched the surface today. There's always more to learn and explore.
That's what the Deep Dive is all about. We want to empower you, the listener, with the knowledge and the insights you need to navigate, this ever-changing world of finance.
As we wrap up, I just want to leave you with this thought. The Dow Jones, while it is, a powerful indicator, is just one piece of the puzzle. Just keep exploring, stay curious, and never stop learning.
Beautifully said. And remember, the best investment you can make is in yourself and your own financial education.
Thanks for joining us on the Deep Dive. Until next time.